Know what is happening with Motilal Mid Cap, because it's been an exceptional case of extreme outperformance to now like in red constantly, negative constantly.
What is your expectation? First of all, let us have that thing very clear. We are designed to be consistently inconsistent. When growth cycle will be in flavor of the market cycle, then you will find us somewhere on the top quartile, right?
You did not change the style early on, and you've reduced the IT exposure only in the last 2-3 months. You've increased the number of stocks only in the last 2-3 months. Did it not deter you, the fact that people are feeling so uncertain about IT now?
Our underlying belief is that eventually long-term growth will play out.
So the churn at Motilal Mid Cap is also higher than 100%. So why did the reshuffling not, translate into better returns?
We are convinced that we don't want to change our style of investing, and which is why we increased our exposure to the IT space where valuations were not looking wacky.
But if I think about it from a layman investor's perspective, they have realized that if a fund starts to underperform, maybe the underperformance lasts for about 2-3 years. Would they not be tempted to, let's say, start an SIP in another mid-cap fund, which is doing well right now?
Every year when I'm seeing my performance, I'm in the best funds. It doesn't happen that way. It's not practical.
What can retail investors expect from Motilal Mid Cap? How soon can they expect it to recover?
We will ensure it comes back sooner than you expect.
Hi Akhil sir, welcome to Power Up Money. I'm very excited to host you today.
Thank you so much, Anvi.
So I'll jump right into it, sir. Mostly, I think I want to discuss the performance of, Motilal Oswal Mid Cap Fund.
Yeah.
So a lot of investors have been feeling confused, and a little unsure about what they should be doing about the Motilal Oswal Mid Cap Fund. So I thought we'll just bring their questions and anxieties to you so that you can help,
absolutely
address them.
Absolutely.
So we know that Motilal Oswal Mid Cap Fund has stood as one of the strongest performers in the last few years, right? I mean, even if you look at the 1 year, 3 year, 5 year rolling returns, it is at 34, and 28%, which is incredible. But the picture flips in the last 1 year, which is in the last 6 months, it's about minus 16%, and the last 1 year, it's about minus 9%.
Yeah.
So what changed?
So, thanks for bringing up this topic. And, to begin with, I would like to thank all our investors and distribution partners for making this fund a stellar fund. Over the last 3 years, the fund AUM has actually grown from about 2,000 odd crores to today 35,000 crores. At peak, this was 38,000 crores. Of course, the fund did exceedingly well, like you said, between 2022 and late 2024. Seriously, very high performance, both in terms of absolute returns as well as relative returns. Full marks goes to the fund manager, and the fund manager was Niket Shah. The reason for the fund to do so well over the last few years, of course, was very strong stock selection. Now, what has happened over the last 12 months is that largely market style rotated from growth style to value style over the last 12 months. So a lot of profit booking which happened in the sectors and the spaces where those sectors and those stocks had given very high returns. And typically this was all largely in the growth oriented sectors or growth oriented stocks. So profit booking happened there, and the money rotated into the value style sectors or stocks. So before the war, if you see the trailing 12-month returns, of course now the picture has changed, everything has come down. But if you see on a trailing 12-month basis as on 20th of Feb 2026, then the best performing sector were largely PSU banks, right? Now this doesn't fall into our growth theme.
Right.
I think the sector itself gave a return of something like 35-36%. We did not get participation in that. If you look at the CPSE index, the centralized public sector enterprises, that basket also gave a return of like 35 to 40%. Defense gave a return of 65%. Metals gave a return of 45%. Now, largely these spaces where there were positive returns, they fall into the value bucket, right? And the spaces where we were invested, largely if you see it, we were in mid-cap IT, which gave us pain. We were in electronic manufacturing services, which gave us pain. We were in consumer discretionary sector, which gave us pain. So the same stocks which have given us pain over the last 12 months are the same stocks which have given us multi-bagger returns over the 3-year period, right? So those investors who have been in the fund for 3 years, 4 years, 5 years, typically are not the ones who would be complaining or would be anxious. But those investors who came towards the end of 2024 or early 2025 have gone through this kind of a negative return over the last 12 months.
So I understand your point on the market was rewarding a different kind of investing, and those are sectors that Motilal Midcap was not invested in, for example. But why didn't the style change? Because I mean, from what I realize, it's also the churn at Motilal Midcap is also higher than 100%. So why did the reshuffling not, translate into better returns?
So this is a absolutely pertinent question. If you look at our style of investing, we have positioned ourselves as growth style investors, right? So in the industry, if you see, there would be value biased investors, there would be growth biased investors, and there could be investors or fund managers who have both the styles, right? Our DNA, our pedigree is largely positioned around growth, which means that back the businesses where we can see strong underlying earnings growth available at reasonable price, and over longer term period we feel growth is equal to return. Right, so we believe in the growth philosophy for long term. If you see in correspondence to growth and the price in last 12 months, while the underlying growth of the mid cap portfolio has still been very, very strong, it's just that the price correction has happened or the PE multiple has kind of got corrected. So
the PE multiple is still higher than the benchmark, for example.
Yes, it will be because it comes with higher growth. Right. So,
what does that simply mean for a retail investor?
See, for a retail investor, eventually, when you're creating your portfolio, you have to buy few funds. You have to buy these few funds which are different from each other, both in terms of style, in terms of portfolio. And when you do this, you're trying to de-risk your portfolio amongst different managers, different styles, different portfolios, and therefore different outcomes. Now, in different cycles, different fund will outperform each other. But as an investor, your portfolio will be a lot more linear, a lot more secular, a lot more consistent. So if you see and you're tracking a lot of data, there are hardly any fund managers you will find who will be on top forever and ever. There is no fund manager who will be on top forever and ever. They all go through cycles.
I understand, but the underperformance of Motilal Midcap has also been quite exceptional.
Exactly. The outperformance was also exceptional and therefore the underperformance was exceptional. Now, couple of things. Usually when you go through a tough phase, usually when you go through a phase of correction, usually when you go through a phase of underperformance, obviously no fund manager would want to see the fund perform the way it does, right? So that is the time we get alert. That is the time we try to introspect. That is the time we try to look at the existing portfolio. Now, over the last 12 months, what you would have seen in the portfolio is that we have tried to change the portfolio in a dramatic way. The portfolio used to be very, very focused around 18 to 20 stocks for a very, very long period of time.
It's still under 30.
At this stage, we have diversified the portfolio from 18 stocks to today, as we speak, 27 stocks. At the philosophy level, we believe in focused portfolios, typically under 35 stocks. So that's our stated philosophy. We don't believe in too much of over diversification in terms of number of stocks. But from 18 stocks to 27 stocks itself means that we have de-risked the portfolio, we have diversified the portfolio. Now, within the portfolio, another anomaly was that there was one single sector, which was Midcap IT, where the weightage was significantly higher at about 20% plus thereabouts. Right now, obviously that brings about a lot more risk in the portfolio. So we have reduced that 20% exposure in the Midcap IT space down to about 12%. Right. So as we are going forward, we are trying to de-risk the portfolio. We are increasing the number of stocks. Any sectoral position where there is an overweight, we are trying to bring it down to more acceptable levels. Apart from that, this is a great time also to do some new ideations. So within the portfolio, what you will see is that all the new entries, about 8 to 9 stocks have made a fresh entry into the portfolio. They are all relatively newer names, in newer spaces, newer sectors, newer themes, right? So we are acting proactively on the portfolio to ensure that the comeback is fast and the comeback is smooth, and then all the investors can be happy once again. It's just little unfortunate that we are in a phase where broadly the markets have corrected because of the geopolitical issues. but we believe that the portfolio is positioned to have a good comeback once things will normalize. I'm very happy to share with you that for the month of March 2026, where the markets have corrected by good 8-10%, the mid-cap portfolio has actually outperformed. So this is the first month we have seen that the fund has done is fallen lower than the market, and therefore there is a alpha, right? So I think all the actions what we have taken in the portfolio in terms of diversification, new ideas, reducing stock level exposure, I think all of these put together will incrementally have a positive impact on the portfolio. Typically, when you're investing in mutual funds, you need to have a longer term horizon. Let me go back and tell you history of Midcap fund, right? Now, this is a fund which is completed 12 years, right? This fund was launched
in 2014.
In 2014, I was just 6 months old in this firm, and this was the first NFO we had done, or I had done here.
Okay.
And we had raised only 75 crores on a lighter note. So over the 12-year period, this fund has compounded approximately 20%. At the direct plan level, it's a 10x for investors. So any investor who's come 12 years back has actually made a 10x.
Okay.
Right. So 100 rupees today, 1,000 rupees, right?
So was it a very conscious call that you did not change the style early on and only, like, let's say in the last couple of months? Because you've reduced the IT exposure only in the last 2-3 months. You've increased the number of stocks only in the last 2-3 months.
Our underlying belief is that eventually in long-term growth will play out. India is a growth market. There are enough opportunities where you can get very good companies with very strong growth. And eventually, like I said, that growth will then transpire into returns also, right? So we are convinced that we don't want to change our style of investing. We will go through some cycles of outperformances, some cycle of underperformances. Average of that is what you make over 10, 15, 20 years, right? So we are not changing that. We didn't want to change that.
So the last time the Motilal Mid Cap fund, I think, had underperformed was between 2019 to 2021. And at that time, I mean, you have gone on record to say that there were a few changes that you made in the fund structurally after that. For example, earlier it used to be very buy and hold strategy, which wasn't a strategy that the market was rewarding at the time.
Yes.
So you moved to a high churn,
Yes.
portfolio style.
Yeah.
Another thing is that I think you added that, you strengthened the team also. There were some leadership changes and all of that happened. And of course, and then we saw this great, incredible run that, we've seen of Motilal Mid Cap. But here we are again.
Yeah.
So is this just something that people should expect? And
they should expect. We are designed to be consistently inconsistent, right? We are designed to be that way. Okay. And why it happens this way is because we are very, very index agnostic. We are not trying to
replicate the
give index plus minus return. We are not designed to do that way. So we are doing many things to ensure that on a longer term basis, we can give reasonably high outperformance than those portfolio managers who are trying to do index plus minus. So, which is what you should expect from Motilal Oswal. Between 21 and 24, largely whatever we had picked was doing well, and therefore there was no major need of doing radical changes in the portfolio.
Sure.
But when we went through a tough phase in last 1 year, then we have to relook at everything. Okay, this goes out, this comes in, this is what we missed out, this is what probably we could have done better. And that is what we have done. This is what you should expect. Okay. That if we will go through a bad time, we will not be sitting on the sidelines and waiting for some magic to happen and the fund comes up. That's what has changed in Motilal Oswal between the first cycle and the second cycle. And look how quickly we have changed the mid-cap fund in the last 2 quarters, or not even 2 quarters, 4 months. The more pertinent question of yours is that why these changes what we have made, we did not make a year back or so. Now there is where there is a fund manager style, right? So earlier Niket Shah was the fund manager for the product. He believed in very, very high focus portfolios. Through the tenure he has managed the funds, if you see his number of stocks have been between 18 and 22, and that is how he outperformed also, right? So that was his own particular style. Through the last 12 months, as we all know, by the end of 2024, valuations of mid-cap were looking very, very expensive. We were also worried on valuations, and therefore in this same fund, you would have seen that Niket tried to keep some cash position in the fund to ensure that if there is volatility, we fall down lower. So multiple points of time you would have seen that the cash was built up and then it was invested and then built and then kind of deployed. So one, we tried to protect through cash. In some points of time it did help us. Secondly, IT pack was looking value or reasonably priced even a year back. And which is why we increased our exposure to the IT space, where valuations were not looking wacky end of 2024.
But did it not deter you, the fact that people are feeling so uncertain about IT now?
Now, so things changed 2 months back. So all this while the mid-cap IT space was all fine. Until this whole AI story built up in January and Feb, when Anthropic came out and said that Claude will do all the incremental coding work, and that created a lot of that knee-jerk reaction with all the Indian IT companies getting butchered up, and we've seen the IT index itself is down like 30%, 35%, and large companies like Infosys, TCS have collapsed by 20-25% or so, right? So it was a very news-driven reaction, lasted for a month or so. Actually, IT has outperformed in the month of March, right? That has kind of helped us to do some outperformance in March. So I think it was very news specific. The intention to keep that kind of exposure was largely because within that space we could find some value in the mid-cap IT. Today also we have 12-13%, largely in two companies. So
in fact, I was looking at the the sector holdings of other mid-cap funds, like the top 5 mid-cap funds today. Their IT exposure is only about 5%.
Yeah, we have 2 companies. We have mid-cap IT because there we find growth. And there is where we find value, right? So we have kept the position over there. We have just simply trimmed it, given the circumstances, given the news around this particular sector. Obviously, you don't want to face the heat, when the markets are giving you a anti, IT trade. So therefore, we have just, from risk perspective, we have brought the weights down, and we have allocated to other sectors and other
But you
businesses.
Clearly still have conviction in IT. Otherwise, it would have trimmed down even more.
So on the technology space, we have 2 spaces where we have comfort. One is, of course, on the mid-cap IT side, and secondly on the digital businesses. So in our portfolios, you will find some names on the new age digital businesses, more tech consumer platforms, and certain very, very specific certain mid-cap IT names. You wouldn't find large cap IT names across our portfolios, right? And that all is happening because of the growth style of investing. These are the spaces where we feel that growth is there or growth will come, right? So eventually everything bottles down to which businesses will make a lot of money. And then you hope that the market cap also will follow the growth of the business, right?
So which sector have you, coming to, let's say, you used to have about 18 stocks and now there are 27. So which sectors have you bought stocks in?
We have increased our position towards financial. So we have added some banks, some NBFCs, some capital market businesses. So that's one space where we have come. Some spaces we have come on the power side, on the renewable power side. So selectively we have done these changes, but largely it's been on the financial space.
The 10-year CAGR, from what I remember, is about 17%.
Yeah, so that's because it's not 17. I mean, the numbers will keep changing, but last count was 19.5 or something. Maybe in the last few days, the markets fall maybe 17%. But it's pretty much in line with 17% compounding itself is a good compounding.
Absolutely.
Right?
But the mid-cap category has been at 20%.
Yeah. No, so if you see, what I remember is the 20th Feb number. I've not seen the 31st March. But on 20th Feb, I think the regular plan NAV was about 89-90 rupees, thereabout. So that's a 9x on the regular plan and 10x on a direct plan. March has been a bad month, so maybe 17%, and the index would be about 18.5%. So there is a gap of about 0.5%, 1%. Largely because of the 1 year underperformance, the 10-year knock has come. Otherwise, if you look at the same performance as on 31st December 2024, then the performance then was 22-23% with a 3% alpha. See, performances also need to be seen from at what market level are you seeing it, right? So today everything will look very different. Today, a year back, Nifty 50, which is your top 50 stocks, the average 5-year compounding was like 20%. Today it is 12%, right? Just because whatever correction.
Sure, all right.
So,
I mean, the recency bias does
broadly
come into
what
play.
you've seen, if somebody has put money for 10 years, 11 years, 12 years, and if you have made 5x, 6x, 7x, I mean, that's a huge wealth creation. 1% plus minus will not really make too much of a difference.
But you tend to compare it to the benchmark because...
You should always compare, because active funds are
the job is
bound
to beat the benchmark.
To beat the benchmark. How do you outperform also needs to be understood. How do we try to outperform the benchmark? One, what is your style of investing? Like I said, we do growth style of investing. So that's one way of positioning your fund for outperformance. Secondly, we do focus style of investing, which means that you keep your portfolio under 35 stocks. Right. So, when you allocate meaningfully to the stocks where we have higher conviction, and when they do well, you get that as a part of your outperformance. Right. Third, very big reason for our rationale for outperformance is that the active ratio of the portfolio is upwards of 80-85%. Right. So we are very, very, very different from the index. Like I said, like today, maybe it might be looking 1% plus minus, but in good times, when the fund is in a good cycle, then it will look like 3%, 4% plus minus, right? So these things will keep changing. So what is your return in absolute terms on a long-term basis? Is that, first of all, good enough? And then,
but that's what I'm saying. I think the 10-year CAGR is close to 17-18%, while the benchmark is at 20%.
So maybe we can check, but I don't think the gap will be more than 1.5%, which is also largely because of what has happened in the last 12 months. So last 12 months, underperformance has been pretty large, right? That has taken a toll on 2-year, 3-year.
It affects it all.
Yes. Similarly, when your cycle is on the top, then all these numbers look very, very different. So like I said, that performances look very different at different points of time, right? So as long as, I'm also an investor, I've been one of the oldest investor in the Midcap fund. I've seen, let's say ₹1 lakh of mine grow up to 7-8 lakh rupees. I'm pretty chilled out. I mean, I'm not really not bothered. The pain to the investor is, the first pain to the investor is negative return. The second pain is underperformance, right? So, which is where we are trying to work hard to ensure that all my investors who have come a year back, how do we bring these guys back into online, recover back whatever the negative returns have come. And as we will improve our performances, it will reflect in the outperformance also. And I've given you all the rationale of how we are trying to do outperformances.
Right. So, in the last 2-3 years, of course, the Motilal Mid Cap Fund has grown by a lot. The AUM is today around, I think, 34,000 crores. Does the management style demand to be changed when the AUM increases?
No. So, size has not been a problem. Size has not been a problem because, again, if you see over the last few months, we made multiple changes. There is enough depth in the market. We've done several block deals without any price impact. We have bought businesses, we have sold companies. So in this particular fund, if you're asking the size being an issue, no.
Okay.
Size is not an issue.
And generally, is size an issue with concentrated portfolios?
In certain categories, yes, you are right. That size does matter. More specifically, as you go lower in the market cap bucket. For example, if you see our small cap fund, now small cap fund typically is 45 to 50 stocks. While I'm saying that our philosophy is 35 stocks, but that particular fund and that category of fund requires you to manage it from liquidity perspective.
Absolutely.
Have thin weights in businesses, and therefore the tail will look slightly longer.
Right.
But any fund where the market cap is on the higher side, so let's say mid cap, upper end of mid cap, large cap, you can run very tight portfolio.
But even with mid cap, I think the tightest portfolio is being run by Motilal Oswal, right?
Yes. So that's the reason why you should buy it. that is the reason that it's very, very distinct. It's very distinct in terms of size, in terms of portfolio construct, in terms of theme selection, in terms of positioning, in terms of active ratio. What else would one want to, if I have to diversify my portfolio? To be very honest,
a retail investor would not care about the holding so much. If you run a concentrated or, over diversified portfolio also, as long as they are getting their returns and their stability, they wouldn't care as much.
So my experience over the last few years is that we should not underestimate retail investors. I think today's investors, and in this space, a large part of our investors, you'll be surprised, is in the age band of 28 to 35. Right? These are all young guys, and they are on mobile apps. They are all clicking and seeing the portfolio. They are clicking and seeing past track record. They are clicking and seeing manager. They're seeing everything, right? So they're pretty aware.
So also, sir, I wanted to understand, like, of course, Niket Shah was, leading the fund for the last 8 years, and there's been a change. And I think now Ajay Khandelwal has been leading it for the last couple of months. What can people expect in terms of how they will run the fund? Will there be any change?
The overall objective of our investment team, or the goal of the investment team, is to give smooth, stable, consistent return over medium to longer term basis. So that's the main objective of the fund manager, right? If you look at track record of Ajay Khandelwal, he's been managing our large and mid cap fund, small cap fund, pretty stable person, keeps 30-35 stocks. If you see his stock level exposures also typically will be between 4 and 5% per stock. It's a very well balanced
it's a style
portfolio.
Similar to Niket Shah's, would you say?
Niket was slightly different, and Ajay was slightly different, clearly, right? So Niket used to take strong bets, but Ajay, I would say, in terms of style orientation, is largely more balanced, right? So, and that is what he is trying to do in the portfolio. When I explained to you that we have 27 stocks, maybe this will go to 30 or 31 or 32 over a period of time, and not taking too much of risk in terms of stocks and some sectors, some stocks, right? The only thing one should be prepared for with us, and with in generally when you're doing investing into mutual funds, is that you have to understand that which manager is practicing what style of investing, and try and buy multiple managers with multiple styles of investing. That will help you in de-risking. So when growth cycle will be in momentum or in flavor of the market cycle, then you will find us somewhere on in the top quartile, right? Similarly, when value does well, like in the last 12 months, then you will find some of the value managers will be on the top. Willy-nilly it will be on top, right?
Sure.
And this keeps rotating with the cycle.
So is it something that would your message to the retail investors be that every 3, 4, 5 year, I don't know what that period is, underperformance should be expected?
When do you expect underperformance? When you have had massive outperformances. So when any fund has massive outperformance, top of the charts, talk of the town, huge media coverage, and the fund sizes are growing, these are the times when the fund is very, very tailwinded, right? I would say one should have a contrarian mindset, counter-cyclical mindset, and one should be cautious investing into funds which are doing exceptionally well, which includes our funds also, I can say that, right? But the same funds, when they go through a cycle and they are getting hit by all sides and there is a lot of criticism, that is the time you need to start tracking these portfolios, and that is the time you have to make the entry. So if at all there is a whole thought of buying low and selling high, then buy good fund managers with very strong track records who are going through a little bit of a
bad patch,
right? So because then that is the time you're buying the bottom, and that is the time the fund manager is also very active on the portfolio.
What can retail investors expect from Motilal Mid Cap?
Yeah. So early signs are very positive. We have been through a rough cycle of last 12 months. We have done whatever changes which needed to be done. I would say that stay put. It will take some more time for the catch up to happen. Nothing happens overnight. You don't fall down overnight and you don't go up overnight. So my suggestion to all the existing investors, if you have done a SIP, continue doing the SIP, because you are buying at the lower end of the fund cycle, right? Markets are also bottoming out, fund is also bottoming out, so you're buying low. So you're averaging, and that's the concept of SIPs. If you don't have a SIP, you just put a lump sum money, just stay put, right? But if you believe in what I'm saying, that markets go through cycles, fund managers go through cycle, then clearly one thing what I've learned over my 25-26 years of experience is that buy good fund managers in their bad cycles, then you make seriously a lot of money.
I understand what you're saying, but let's say if I think about it from a layman investor's perspective, right? If a fund is underperforming, and let's say that they have realized that if a fund starts to underperform, maybe the underperformance lasts for about 2-3 years. Would they not be tempted to, let's say, start an SIP in another mid-cap fund, which is doing well right now?
Incrementally, you can do that. But whatever SIP you started with, the faith you invested in a Motilal Oswal Mid-Cap fund, your faith should not dwindle purely because of 1 year underperformance. That's what I'm saying. Assume you bought in 2024. Assume you bought when the fund was really doing exceptionally well. Right. Now you have bought then. The same fund with whatever belief you came in today is coming to you at 10-15% lower NAV. What has changed? And why should you not get further excited? The same thing, you are getting 10-15% at discount. Why will you leave it? And from behavior perspective, if you bought something on top, perceivably, then at least don't sell on the bottom, because then that's the second mistake you do.
But let's say if I'm only investing when the fund is performing well, and I stop the SIPs right now, let's say for 2 years when the fund is not performing very well, wouldn't the returns be, let's say, overall returns be better?
Forget about Motilal Oswal or whatever, right? Yes. Let's look at 10 years average, and let's look at flexi cap category, because it's a nice category to look at, because large, mid, small, everything is there. So let's look at this category. A typical average return of a flexi cap fund, average return over the last 10-year period would be about 13 or 14 odd percent. Average return. Largely over a longer term period, you will end up making money. Even if you are in the worst fund, you are making 11-12%. I mean, how unlucky can you be, right? So that is what I'm trying to explain to you, that think 100 times before you cut check in a fund house, right? Whenever you're making your investment, think 100 times. But when you have invested, then give it a 10-year cycle. That's what I say. It's very difficult to predict that, everybody wants to be, every year when I'm seeing my performance, I'm in the best funds. It doesn't happen that way. Now on 1 year rolling return, the average return is 21%. Average. But because it is 1 year, the probability of losing money or a negative return is 17%. Out of which there is a 7% probability that you would have lost more than 10%. Which has been in 2017 in this fund and last year. Only 2 years when the fund went down more than 10%. But negative return, there is a 17% probability. Now on a 3-year rolling return basis, the fund is given about 18.5 or 19%. That's a 3-year rolling return. Any 3-year investor has made somewhere in this kind of a return band, right? The chances of getting negative return goes down to 7%. And on a 5-year rolling return basis, the return is about 16-17% and zero probability of losing money. That is what this fund has given over a 12-year period track record on 1-year rolling, 3-year rolling, 5-year rolling. That is what you have to see.
But should the, like a retail investor, you would agree, would want like stable returns throughout. So in such a situation, like outperformance or neutral, like they wouldn't want to see a fund that they're investing into underperform. So what should they expect in, let's say, the coming 6 months, 1 year?
What they should expect is that no fund is going to give them stable returns at all points of time. Believe me, I'm not speaking this as a representative of asset management. I'm speaking that this after my own investing experience of last 26 years, where I've lost money in funds, where I've made money in funds, and I've learned, and I don't have expectations of all this. So I take a lot of time deciding where I want to put, which funds I want to put. What is your portfolio? What is your expectation of return? First of all, let us have that thing very clear. That, me as an investor, or let's say you as an investor, over 10 years, I'm expecting a 15% CAGR. Then you design your portfolio for 15%. And then within that, you do diversification. Like my parents. Now, my parents' expectation is not 15% and 18%. They are very happy with 3% over the fixed deposit. Right, and they moved all into equities. Me personally, I have like very, very high expectations. So my portfolio design is very, very different, right? You may be somewhere in between. So it all depends on, what is your return expectation. Once that goal is set, you have to do all your reverse calculation. The underlying message I'm just simply giving is that do a lot of homework before you decide the fund you want to invest.
So, of course, I mean, I don't expect you to, predict the future. But when do you think we can start seeing like better performance?
Very difficult to time, but I think the worst is behind us. right? Last month has been a good month in a very bad market cycle. If we have managed to do well, I think that's a good perfect setting. I expect that worst come worst, give it 4 quarters from here. You will see, and see, it will happen slowly. 1 month will get better, then 3 months, then 6 months, then 1 year, then 2 years, then 3 years. So it's a process. It's a journey. Small cap fund, despite a bad cycle, it's doing fine. You can have a look at it.
Flexi cap is underperforming though.
So Flexi cap, Mid Cap, Business Cycle, Multi Cap. These 4 funds were under Niket. Because the fund manager was common, the overlapping of ideas was common. Style was common. So when one fund manager goes through a bad time, largely all his funds will go through a bad time. Now,
since you brought up these
that's
funds,
a very good point. Thank you for bringing this up. Now, what we have done is, as Niket has moved on into our group company, we have now distributed all his funds to multiple managers. Right. So now that diversification also we have done. So the multi-cap fund has gone to Sandeep, the business cycle fund has gone to Varun Sharma, and Flexi and Midcap is with Ajay Khandelwal, right? So we have distributed the funds. So you will find same portfolios now will look very, very different from each other. Therefore, the experiences will be different, right? And incrementally, like you talked about, what changes should we expect? I think we will continue to invest in building strong teams, right? We are looking at getting a very strong head of equity, CIO equity for mutual funds. At this size, probably we are one of the largest investment team, 42 people. We have almost 13 active fund managers, and you will see more will join in.
I'm also curious to know what role is cash going to play in this period for you? Because I think the cash holding is about 5 to 11%.
We have deployed, we have tried to take advantage of these corrections. So largely, if you see across our funds, we are under 3% in cash, which used to be slightly higher a couple of months back. So, but largely I would say that as a philosophy, we don't want to do too much of, taking calls on cash, etc. beyond a permissible level. So there is as per risk management policy, we have a 8 to 10% kind of limit. If occasionally any manager wants to utilize that, then they can utilize. But largely the mandate given by the investors to us is to have 100% investment into equities, and it's all about relative business. We will do what the mandate is. Yes, exceptional scenarios like 2024, we were compelled to build a little bit of cash position because seriously markets were very expensive. There were lack of ideas. SIP flows were coming inside, and we had to be very prudent before deploying the money. So we try to use that at that point of time. And
does that feel like a good problem to have?
It's a bad problem to have, that you're getting money but you're not able to invest. It's not a good problem, it's a bad problem. And I've seen largely in the industry, within our own investment team, they have to work 10 times more in at elevated valuations, searching for that which idea where you can buy at a good price.
Are mid-cap valuations like normal according to you now?
So, if you see it's corrected quite a bit, right? I think the peak PE multiple for the mid-cap 150 index was 43 times end of 2024. It's come down to, I think it's come down to about 27 or 28 times. So there has been, and if you see the premium of mid-cap over large cap has come down from 100% to under 50%. So there has been a serious de-rating on the PE multiple. But if you see the 5-year average, maybe there is some more scope, 10-15%. Agar aur niche jata hai, so then you will hit the low of 21 or 20, something like that, right? But today's level is far more comfortable than what it was a year and a half back, both in terms of mid-cap. In fact, we have seen more correction in the small cap front. So small cap is looking from purely valuation perspective, index.
So valuations for small cap you think are like normalized now?
It's looking far more reasonable.
Fair.
Far more reasonable than mid cap and then large cap. I mean, in last 30 days, March 2026, जो भी बचा कुचा था वो भी हुआ है नीचे, right? So your Nifty 50 itself is now down to what, 19.5 times. So valuations are getting better. Is there a scope for further correction? Yes, but now the scope is getting smaller. A year back,
but it's painful to look at like a portfolio.
It is very painful. And therefore, all the investor meetings, what I do is there are two things one have to do today. One, please do not touch your existing investments. This is not the time you sell, right? Because this is a time where sentiments and emotions are, superseding your fundamentals. So this is not, please don't sell, first of all. Secondly, if you're lucky to have some cash in your bank which you can deploy for 5 years, then this is the time you start doing cherry picking, right?
Where would you deploy your lump sum right now?
So largely, particularly me, I'm largely a mid-cap, small-cap. So large part of my investments actually go into our own mid-cap funds, small-cap funds. But there is a small portion which I do in a different. So 80% is all Motilal funds, 20% is non-Moti. So that non-Motilal funds I do in a value style fund manager, more in flexi-cap funds. But largely I'm biased towards mid-cap and small-cap because I feel that in India, most attractive opportunities are in mid-cap and small-cap. Attractive sectors, attractive businesses, entrepreneurship, innovation, all that excitement in India is in that space.
No, makes sense. Thank you so much, Akhil sir, for clarifying that. I think this is extremely helpful. And a lot of our investors and our audience is feeling, of course, anxious and unsure about what is happening with Motilal Mid Cap, because it's been an exceptional case of extreme outperformance to now seeing it in red constantly, negative constantly. But this perspective, I think, really helps and will help them understand what to expect from Motilal Mid Cap in, let's say, the near future, and of course maybe give them more confidence and staying put.
No, absolutely, Anvi. I can't thank you enough for doing this podcast at the right time. We are active on our portfolios 24/7. We are 10 times more active on the portfolios which don't do well in a particular period of time. So do track our portfolios month on month, quarter on quarter. See whether are we acting, are we changing. We will also communicate through all the mediums to give you that sense of importance we are giving to the portfolio which go through a little bit of a turbulent time. This is not the time to panic and make wrong decisions or exit out. But one thing, please do not worry. We are on the job, and we are a battery of people who are on this particular fund, and we will ensure it comes back sooner than you expect. Thank you so much for 100%. The opportunity.
Thank you so much for the opportunity.
Thank you.